Hello and welcome to an overview of earnings per share. Watching this video will help prepare you for class. It is important that you view this before class so we can learn more together in class. This video will introduce you to the terminology associated with computing earnings per share. After viewing this video, you will be able to compute weighted average number of shares, compute basic earnings per share, and state the four financial instruments that are common stock equivalents, and explain what dilutive and anti-dilutive EPS means. Earnings per share is presented at the bottom of the income statement. There are two different earnings per share, basic and diluted. Basic earnings per share is computed as net income less preferred dividends divided by the weighted average number of common shares outstanding. Outstanding means the shares are owned by outside investors. Treasury stock owned by the company is not included in outstanding shares. Earnings per share is computed for common shares only. Common stockholders are not entitled to the dividends of preferred stockholders. Using the weighted average considers the period of time the shares were outstanding during the year. This is consistent with net income that is earned during the year. Changes in outstanding shares must be considered to determine the weighted average number of shares outstanding. Treasury stock is subtracted from outstanding shares. Reissuing treasury shares to other investors increases the number of outstanding shares. Stock dividends and stock splits are considered to have occurred at the beginning of the year for consistency. The exercise of stock options and warrants to purchase common stock increases the number of outstanding shares. Let's talk through an example and compute the weighted average number of shares outstanding. Several changes to the number of outstanding common shares are given in this example. Start with the number of shares on January 1st. On the second line, write the date of the first change to outstanding shares and the number of shares on this date. The company issued 3,000 more shares, increasing the shares to 53,000. We will come back and talk about multiplying by 3 and by 3/12 in a moment. On the next line, write the date of the next transaction that changed the number of shares outstanding. On July 1st, the company declared a 3-for-1 stock split. This means the company gave shareholders 3 shares in exchange for every one, tripling the number of outstanding shares. After the stock split, the company will have 3 times as many shares, or 159,000. The 3 times must be applied to every line item above the stock split line for consistency. This is referred to as retroactive to the beginning of the year. The next transaction that happens on September 1 is a purchase of treasury stock that reduces the number of outstanding shares. The final transaction is to reissue 3,000 shares of treasury stock and increase the number of common shares outstanding. After this, multiply each line by the number of months that the shares were outstanding and divide by 12. For instance, on the first line, the company had 50,000 shares outstanding for 3 months before a change was made. This line is multiplied by 3 months over 12 months. Do this for every line item and add up the number of shares to get the weighted average shares outstanding. The final step is to subtract the preferred dividends from net income and divide by the total weighted average shares outstanding. Cumulative preferred stock dividends are always subtracted even if they were not declared this year. Basic EPS considers the actual number of shares outstanding during the year. Diluted EPS considers the number of shares that could have been outstanding, given other financial instruments were converted into common shares. Financial instruments that can be converted into common shares are referred to as common stock equivalents. Diluted EPS is the lowest EPS could be given net income is the same and the common stock equivalents currently owned by investors are converted into common stock. It is a worst case scenario. There are 4 common stock equivalents that we will discuss in this class. Diluted EPS assumes that each of these common stock equivalents are converted into common shares. The first one we will discuss is convertible bonds. Bonds are debt with interest expense. Convertible bonds can be repaid with common stock instead of cash. We will assume the convertible bonds are converted into common stock and the debt is repaid. The debt will no longer exist and interest expense will not be incurred. The second one we will discuss is convertible preferred stock. Convertible preferred stock can be traded for common stock. We will assume that preferred stock is traded for common stock and the preferred stock no longer exists. If the preferred stock no longer exists, then the preferred dividends is not paid either. The third equivalent that can be traded for common stock are stock options. Stock options give employees the option to purchase common stock from the company at a set price. We will assume the company uses the cash received from employees to purchase common stock from other shareholders. The increase to common shares will be the net of the shares issued to employees less the shares repurchased. The fourth equivalent that can be traded for common stock is warrants. Warrants work the same as stock options and are treated the same. The treasury stock method for stock options and warrants provides a few rules for us to follow. We will assume that options are exercised when the market price of the common stock is higher than the exercise price for most of the year. The employee would be able to sell the stock for more than they paid the company, earning a gain. As such, it is safe to assume the employees would exercise the option and the number of common shares outstanding would increase. The exercise date is assumed to be at the beginning of the year as long as the options were granted before the beginning of the year. The options are assumed to be exercised on the date of grant if the options were granted during the year. For options, it is assumed that the company uses the cash received from employees to purchase common stock and reduce the shares outstanding. We will assume the shares are purchased at the average market price of the stock during the year. This amount will always be given to you. The if converted method provides the rules related to convertible bonds and convertible preferred stock. We will assume conversion, which will result in no debt and no interest and no preferred stock to pay on preferred dividends. Assume the conversion occurred on the first day of the year, unless the bonds or preferred stock were issued during the year. If they are new this year, assume conversion on the issue date of the bonds or the stock. Anti-dilutive means that diluted EPS is greater than basic EPS. This is not allowed under GAAP because it will not be a worst-case scenario. If anti-dilutive occurs, do not assume conversion of the convertible that is causing the anti-dilutive situation. After viewing this video, you should be able to compute the weighted average number of shares, compute basic EPS, and understand the 4 common stock equivalents in the assumptions that are made. You should also be able to explain what diluted EPS is and what anti-dilutive EPS is. We will walk through a complete example of how to compute basic and diluted EPS with numbers in the next video. Thank you for taking the time to be prepared for class. It is very much appreciated.